Now, we're going to start with the options market, and that's what we talked about in week 32 in Volatility Crush. The core thesis of the Volatility Crush piece is we're looking at these two metrics at the top here, implied volatility and delta skew. Now, implied volatility is it's part of the volatility premium that gets baked into options, part of the probability. How likely is it that some far and away strike price is going to get hit? Now, just to summarize what we saw back then, Bitcoin has historically been within this kind of 60 to 100% implied volatility for the vast, man, this is the full history of our data. So essentially, since options have been trading, Bitcoin has been somewhere between 60 and 100%, except for 2023, where we got down to half of that, between about 25 and 50%. Now, we were down at literally all-time lows as far back as the data goes in terms of implied volatility. At the exact same time, delta skew was hitting pretty much an all-time low. Now, for those who aren't familiar with options, what delta skew, a low value is essentially saying that put options, downside protection, right? People buying insurance in case the market goes lower was the cheapest it's ever been relative to call options. People were preferring to speculate on the upside. Not many people were speculating on the downside or buying insurance for the downside. And the market was pricing in extremely low volatility. So therefore, the question becomes, well, what would happen in a max pain scenario where nobody is insured for the downside and they haven't priced in volatility and we go back to at least 2x back into our previous range? Well, that is precisely what happened. Delta skew explodes higher as people scramble to buy put options, and our volatility shot right back into our range. It doubled pretty much within a couple of hours. So it was kind of one of those things where it was just a very, very simple max pain type scenario. Nobody was positioned for downside, and lo and behold, that is essentially what the market decides to do. Now, options, and we covered this, I can't remember if it was week 32 or 33, but options in terms of overall open interest are now of a similar magnitude. Historically, futures dominated. Options were very small. We're now looking at a regime where options are not quite as big right now, but on a very, very similar magnitude, right? We're not talking about 10% anymore. We're talking about 70, 80, even 100+% of the futures market. Now, what you can see is that overall, for the last couple of weeks, and even including our sell-off, we have not really seen a big change in both put and call option open interest. It's actually been fairly stable. We didn't see any kind of major deleveraging or flush out or panic in the option space. We definitely saw an uptick in volume. It more than doubled during the event, but that's we typically see that, right? High volatility creates trade volume. This is fairly normal. So the big takeaway here is that, yeah, there's no question that options were certainly mispriced for the event that played out, but we didn't really see the cascade forced by the options market. We didn't see a bunch of people panic sell out and all the rest of it.